are three different types of insurance accounts that could help you save your business money. Hi, my name is Melissa DeWeese, and I've been doing insurance for over 20 years, and I have helped thousands of employers with their employee benefits, and I've helped many of those clients save money over the years. The first on the list of money-saving health plans is the HSA. This HSA, it's short for Health Savings Account. Health savings accounts are accounts that are set up and they're owned by each individual or each employee that sets up an account, and it's run through a bank. In order to have an HSA, the first step is to have a high deductible account, a high deductible health insurance plan. Now, it can't just be any high deductible health insurance plan. It has to be an HSA qualified or an IRS qualified health plan. And these plans are not only high deductible plans, but absolutely nothing is covered during that deductible. Most of these plans run deductibles anywhere from about $1,800 all the way up to about $8,000 per person. People do have some sticker shock when they look at those deductibles. However, the idea is that you may be coming from, let's say, a $500 deductible health plan and move over to a $2,000 deductible health plan. In that change, you're going to save some money, right? If you go from $500 to $2,000, the idea is that you're going to be saving monthly on premium. And to take that monthly premium savings and put it into a tax savings account, and that tax savings account is called an HSA. So let's say you are saving $100 a month by moving from a $500 deductible plan over to a $2,000 deductible plan. You can put that $100 of savings into your HSA account tax-free. Now, some states do not honor the tax deduction, like California. However, it will always be federally tax deductible, and of course talk to your CPA before any changes to your taxes. And you take that $100 savings and you put it into your HSA account. At the end of the year, you'll have $1,200. Not only have you gone from a $500 deductible up to a $2,000 deductible, you are filling in the gap for yourself of $1,200 in case anything happens over the year. And you can now deduct that $1,200 from your income and not pay taxes on it. There are many banks out there that offer HSAs. Many times we use Optum, or I use hsabank.com. It's a great resource. Go check them out. I'm not sponsored by these companies in any way. There are limits to how much you can put away into a health savings account and still receive the tax savings. In 2024, the maximum for an individual is $4,150, and for a family is $8,300. Every year that is adjusted, and it will be adjusted in 2025. In 2025, it will be $4,300 for an individual and $8,550 for a family. Now, family is basically an individual plus one or more. So that could be an individual plus a spouse, an individual plus a child, individual plus children, or a full family, which is a individual, spouse, child, or children. And some of the questions that I get asked when talking about HSA accounts is, what can I spend this money on? You can spend this money on qualified health expenses. Now, these are defined by the IRS, and basically they're your deductibles, your copays, coinsurance, anything that your health plan is covering that your health plan is paying a portion of. So all medical expenses that are covered by a health insurance plan are typically going to also be covered by an HSA, and you can use the money in your HSA funds to fill those gaps. You can also use it for dental services, vision, orthodontia, and other things, even some over-the-counter medications, such as allergy medications, pain medications, cold and flu, and so on. So these qualified medical expenses, in fact, are exactly the same as the qualified health expenses for a FSA, which we will be talking about next. So hold your horses on that. So I'm just going to wrap up a couple more points on the HSA before moving on to the FSA. Now, HSA is not a use it or lose it plan. So the point of the HSA is to continue to save money, put money away every month or every year, save money on your taxes, and accumulate money over time. And you can use it upon retirement and withdraw the funds once you hit retirement age or age 65. As you accumulate funds, many of these banks will also allow you to invest this money in the stock market. Many of them are attached to money market accounts, or you can even buy and sell individual stocks or mutual funds within these accounts. Most of these companies do have a minimum amount that you have to have in your HSA in order to do so. Many of them, it's about $10,000 prior to being able to use the money for investments, but it is an option, and the earnings made from any investments within the HSA are tax-free. So it's similar to an IRA in that way. The next list of health plans that can save a company money is a FSA. FSA stands for Flexible Spending Account. And there are multiple types of flexible spending accounts. They are built on the chassis of the Section 125 plan, which many of you HR folks out there will be familiar with. A Section 125 plan, most of the time, companies set this up for the premium only plan portion of the Section 125 IRS code and plan. And this allows employers to deduct money from the paychecks pre-tax. Now, you can add to your Section 125 plan one of these FSAs or flexible spending accounts, or all of them. There is a health FSA, a child care FSA, and a transit and parking FSA. So the health FSA is the most popular. However, if you add this plan, you might as well add the dependent care. And if you live in a highly dense populated area, your employees may need help with bus fare or with parking, and that is what that transit and parking FSA is for. Now, you don't have to do all three, you can just do one. However, a lot of the times the cost to doing all three is very similar to the cost of just doing the health plan or just doing the dependent care FSA. So what is it? A health plan FSA is a plan where an employee can set aside money pre-tax from their paycheck and use those funds for medical expenses. The same qualified medical expenses that we talked about with the HSA. It's the same exact list. It's anything that would be covered by your medical insurance, like deductibles, copays, and coinsurance to fill in those gaps. It also is any dental care or orthodontia or vision care, eyeglasses, also some over-the-counter medications like we talked about. And I will include a link of qualified medical expenses in the description below. And it works a little differently than the HSA. So the HSA, let's say you're putting $100 away per month. That $100 is only available when you put the money in the account. So let's say you plan on putting away $1,200. You don't have access to that $1,200 up front. It's only available as you accumulate money in your HSA account. The FSA, let's say an employee sets aside $1,200 in their medical FSA, they have that money available on day one, even if they haven't made a contribution from their paycheck into that account. So day one, they can access that $1,200, use it all, and pay it back over time. Now, this leads me into the downside of the FSA for employers. Some employers get nervous that those employees have access day one. They worry that those employees will leave, use the money and leave and not pay them back. And yes, that can be a downside to the FSA. And when we look at these sorts of plans, it's important to make sure you have low turnover and loyal employees, and that you know that if an employee leaves, you could potentially lose that money and be okay with it. Now, the downside to the employee is, let's say they don't use the money, they don't use that $1,200 and the year ends, they lose it. So it's a use it or lose it rule. So there is a counterbalance here to, an employee taking the money and running. The employer could end up getting the money that the employees aren't using. So all these rules are there to make sure that the employee is using it within the calendar year. And yes, there's a downside to the employer, but there's an equal downside to the employee if the funds aren't used. And there's also a dependent care FSA that is very popular. Childcare is very expensive, and so is elder care, and it can be used for both. So if an employee has an aging parent that needs help, or a young child that they need help paying for with childcare, an FSA allows that employee to set childcare funds aside, tax-free, to help pay for childcare or elder care. So very popular option, and similar to the prior to the transit care, allows employees to set aside money tax-free to pay for transit or for parking. Now, the third money-saving health plan on my list is an HRA, and this is a health reimbursement account. There are several ways to set up an HRA. One of the ways to set up an HRA is to allow employees to use a set dollar amount towards individual health plans. So this is for employers who are having a hard time picking a group health plan. They can give the employees a set dollar amount to go out and shop the individual health insurance market and use that money towards their new health plan. Many employers are taking up this option and being successful with it. They like the freedom of the employees being able to choose. However, it can take up some time on the employee's end to do the shopping. So some employers opt for a group HRA that's also known as a wrap plan. So similar to the HSA, where the employer may be going from, let's say, a $500 deductible up to, let's say, a $2,000 deductible and saving some premium, those employers can set up an HRA wrap plan to fill in the gap, fill in that $1,500 that is missing from their previous plan to help the employees pay that deductible. Now, if an employer sets up an HSA and they give those employees money every month, which is what some employers do, they may either have the employees only contribute to the HSA, or the employer may also be contributing to the HSA. Instead of doing that and giving money every month, a set dollar amount every single month to the employees, the advantage to the HRA for employers is the money doesn't get spent unless the employee uses that deductible. Many companies have found over the years that maybe only 20% of their population is actually using any significant amount of their deductible. So they think to themselves, why am I paying the insurance company for this low deductible when most of my employees aren't even really using the plan? And if they are using the plan, they're only using a couple $100 worth of it. So this is a way for employers to take back some of their premiums, add to the savings, and use that savings dollar to guarantee the employees that, hey, if you do have something catastrophic and you want to fill in that deductible for your employees, you have a mechanism to do so. I have done this strategy with employers for over 20 years now. It's been extremely successful with some of my groups. I've saved groups hundreds of thousands, millions of dollars with some of them over these years with these plans, and they do work. Now, the downside to these plans, of course, not everything is rosy and has a perfect solution, is it is a little bit more work for the employer and for the employees. You do have to hire an administrator to administrate those claims. You don't want your HR person sitting there writing checks to employees or sitting there writing checks to the doctor's offices and the hospitals and figuring out, is this a legitimate claim? Is it not? Is it cosmetic surgery? Is it fraud? Is it a legitimate claim? You don't want to bog your HR down with that. So what we recommend is to hire an administrator to manage all of those claims for you. And the bumpy side of the HRA is usually that first year of training the employees that there is an administrator you have to use, or sometimes we can even set up something as simple as a debit card for the employees to use when they want to access that money. So it is an extra step. Some employees don't like it. However, this is a bad year for medical insurance. Medical insurance costs are going up more so than they have in the last 4 or 5 years. Employers are really getting pinched by inflation, and now medical inflation and health insurance inflation is hitting them right now. And these are 3 solutions that you may want to consider at your next renewal in order to save money or maintain the costs that you have currently to mitigate cost increases. And if you have any additional questions, of course, I'm here to help. I also have a link down below to tell you more about my company, set up a meeting with me, and thank you for hanging out until the end. We'll see you next time.